For years, stock buybacks were something only financial insiders paid attention to. They showed up quietly in earnings reports, mentioned briefly on investor calls, but rarely became part of the mainstream conversation. But now that's changed. Big companies are buying back their own stock at record levels. Billions, sometimes tens of billions, are being spent not on new products, not on hiring, not on expansion, but on purchasing shares of their own company. At first glance, it can seem confusing. Why would a company use its cash to buy its own stock instead of investing in growth? The answer reveals a deeper shift in corporate strategy, one that's less about rapid expansion and more about control, efficiency, and shareholder value. To understand this, you have to start with what a stock buyback actually does. When a company buys back its own shares, those shares are removed from the market. This reduces the total number of shares outstanding, and when that happens, each remaining share represents a slightly larger ownership stake in the company. That alone can increase earnings per share, even if the company's total profits stay the same. In other words, buybacks can make financial performance look stronger on a per-share basis. But that's just the mechanical explanation. The real reason companies are buying back stock at record levels is tied to how they see their own growth opportunities. Many large companies today are incredibly profitable. They generate massive amounts of cash every year, but at the same time, they are finding fewer opportunities to reinvest that cash into high-return projects. In the past, companies could pour money into expansion, entering new markets, building new products, or scaling rapidly. But as companies mature, those opportunities become more limited. Growth slows down, markets become saturated, and the returns on new investments are not always as attractive as they once were. So companies face a decision: what do you do with excess cash when you can't reinvest it efficiently? One option is dividends, paying cash directly to shareholders. But buybacks offer more flexibility. Unlike dividends, which create an ongoing expectation of regular payments, buybacks can be adjusted based on market conditions. Companies can increase or decrease them without sending strong signals of financial trouble. Another reason buybacks have become so popular is valuation. When companies believe their stock is undervalued, buying it back can be one of the best investments they can make. Instead of acquiring another company or building a new project, they are effectively investing in themselves. If the stock price rises over time, that decision can create significant value for shareholders. There's also a strategic signaling effect. When a company announces a large buyback program, it often sends a message to the market. Management believes the business is strong and the stock is worth more than its current price. This can boost investor confidence. But there's a bigger shift happening beneath all of this. Corporate priorities are changing. For years, the focus was on growth at all costs. Companies were rewarded for expanding quickly, capturing market share, and investing aggressively. But today, there is a greater emphasis on efficiency. Investors are paying more attention to profitability, margins, and capital allocation, and buybacks fit perfectly into this new environment. They show that a company is disciplined with its capital, that it is not just spending money for the sake of growth, but carefully deciding where that money creates the most value. Another major factor is the structure of executive incentives. Many executives are compensated based on stock performance and metrics like earnings per share. Buybacks can directly improve these metrics. This creates a strong incentive to return capital to shareholders in this way. But it's not just about incentives, it's also about predictability. Buybacks allow companies to manage their financial profile more precisely. They can smooth out fluctuations in earnings per share and maintain consistent performance metrics. This is especially important in an environment where investors reward stability. There's also a competitive element. When multiple companies in the same industry are generating strong cash flows, they often compete not just on products, but on how they return value to shareholders. Buybacks become part of that competition. Companies that return more capital may attract more investor interest. Another important reason behind the rise in buybacks is the broader financial environment. In periods where interest rates are stable or capital is accessible, companies can even use debt to fund buybacks. This may sound risky, but if managed carefully, it can enhance returns. especially if the cost of borrowing is lower than the expected return on the company's stock. This strategy has been used by many large corporations over the past decade, but beyond all these factors, there is a deeper strategic shift. Large companies are becoming more selective about growth. Instead of expanding aggressively into uncertain areas, they are focusing on strengthening their core business, improving margins, optimizing operations, and returning excess capital to shareholders. This reflects a more mature phase of corporate strategy. It's not about building as fast as possible, it's about maximizing the value of what already exists. However, this trend is not without criticism. Some argue that buybacks come at the expense of long-term investment, that companies should be using their cash to innovate, hire, and build for the future instead of boosting stock prices. Others point out that buybacks can artificially inflate financial metrics without improving the underlying business. These concerns are valid, but from a corporate perspective, the decision often comes down to opportunity cost. If a company cannot find better uses for its cash, returning it to shareholders becomes a rational choice. And in today's environment, many companies are reaching that conclusion. What makes this trend so significant is its scale. We are not talking about small, occasional buybacks. We are seeing massive, sustained programs across multiple industries. This is reshaping how companies allocate capital, and it reflects a broader change in the business landscape. In many ways, buybacks are a signal that companies are prioritizing efficiency over expansion, stability over risk, and shareholder returns over aggressive growth. This doesn't mean innovation is stopping, but it does mean that the balance has shifted. Because in today's market, success is no longer defined only by how fast a company grows. It's defined by how effectively it uses what it already has. And for many of the world's largest companies, buying back their own stock has become one of the most powerful ways to do exactly that.